Welcome back to Sky's Capital, where aviation meets investing. If you've been watching the oil prices lately, you know it's like been flying through turbulent, choppy air. Up 10, down 8, everybody's gripping their armrests. But here's the investment question. When oil gets turbulent, which companies feel the turbulence in their earnings? And which ones are like the airport? They still collect the landing fees because those airplanes still got to land. Today, we're going to track the ripple effect from oil per barrel to the major oil companies and all the way down to the midstream MLPs, master limited partnerships, like Enterprise Products, MPLX, Plains All American, and Western Midstream. We'll keep it practical, what actually changes, what doesn't, and what to look for in your investments. This is for educational purposes only, not investment advice. Let's go. Here's the roadmap. First, what actually moves oil prices. Second, how the major oil companies respond across the value chain. Third, how that response translates into midstream volumes and cash flows. And then we'll go company by company, EPD, MPLX, PAA, and WES. Full disclosure, I do own MPLX and EPD in my long-term portfolio. Oil prices move on supply and demand expectations, such as OPEC policy, geopolitics, inventory levels, refining constraints, macro conditions like growth in U.S. dollar. The key takeaway is the oil is a marginal market, so small changes at the margin can move prices a lot. Here's the core framework for the whole video. Oil prices moves. Price changes produces behavior. Behaviors change physical flows. Physical flows drives mainstream revenues. So the important question isn't whether the oil prices are up or down. It's how does the price level affect activity and volumes over time. Let's ground this energy value chain because where the company sits in the chain determines how oil prices hits cash flow. Upstream production, crude, oil, and natural gas. Midstream is pipeline gathering, processing, storage, exporting. Think of it as logistics and handling. Downstream, refining and selling the products. And here's the key point. The major oil companies are integrated across multiple parts of the chain, so their sensitivity to oil prices is blended. Upstream may benefit from oil rising, while downstream can be driven more by refining spreads and demand than by the headline oil price news. When oil rises, upstream earnings usually improve. Downstream results depends on product demand and refining spreads, not just crude oil prices. In a low price environment, majors often adjust CAPEX and prioritize dividends and buybacks. These CAPEX decisions influence production and midstream volumes later. This is the lag effect. Midstreams generally doesn't change overnight. Higher sustained oil prices often lead to higher drilling and completions, and later higher production. Lower sustained prices usually slow activity and can flatten or reduce volumes in certain basins. Midstreams are often described as toll roads. They earn fees based on revenue per barrel or per MMBTU moved, stored, and processed. So they are not supposed to be living and dying on the daily oil price movements. In aviation terms, think of it as an airport collecting landing fees. Airplanes arrive with different passengers, loads, and ticket prices, but the airport still gets paid when the aircraft lands using its infrastructure. That said, not every midstream cash flow stream is perfectly insulated. Certain processes and marketing structures can introduce real commodity exposure. So when you're evaluating MLP, the question is, how much is it stable landing fee style revenues and how much are tied to commodity linked margins? The correct mix matters. Use this checklist when oil moves. 1. Volumes and activity. 2. Differentials and spreads. 3. Counterpath health. 4. Growth, CAPEX, and permitting. And 5. Tariffs, escalations, and inflation. Bottom line, mainstream is a low beta, not a no beta. Quick bird's eye view before we go deeper. EPDX is a diversified with meaningful NGL and export infrastructure. MPLX is strong and mostly fee-based, but has notable marathon linkage. PAA is crude focused, so flows differentials matter more. And WES is more gathering processing, where basin economics and customer structure drive outcomes. Now let's put some numbers behind this. Here we're looking at three things. One, the fee-based mixed. Two, the distribution coverage, very important ratio when you're looking at MLPs. And three, gross revenues for the last reported quarter. This is not about picking a winner from one slide. It's about understanding the stability versus sensitivity. A higher fee-based mix is more landing fees like. The higher coverage generally means more cushion, and gross revenues give you scale. But remember, midstream's revenues can include large pass-through commodity sales, so it's not the same as a margin. Next, let's talk about scenarios. What tends to happen at different oil price levels? This is a directional scenario matrix, not a forecast. Around $50 a barrel oil, free cash flow compresses, capex gets more selective. That usually means slower growth, and volume softens over time, which can raise distribution risk for weaker balance sheets. Around $70 barrel oil, things tend to balance. Steady capex, steady buybacks, midstream volumes are typically stable or modestly growth. Around $90 a barrel oil, majors generate strong free cash flow. Activity often increases, supporting higher volumes and project backlogs, though you have to keep an eye on inflation and cost and politics. Here's the investor checklist for how oil flows into midstreams. Contract mix, volume indicators, spreads, financial resilience, customer concentration and credit, and growth backlog. So, if you remember one thing, oil prices is the headline, but the activity and volumes are the transmission mechanisms into midstreams, MLPs, that usually comes with a lag. If you want, in follow-up videos, we can build an oil beta dashboard for these four companies using volume, coverage, leverage, and contract mix. If you found this helpful, please like it and subscribe for more Sky's Capital content where we look at investing from 35,000 feet. As always, this is an educational purposes only, not investment advice. Have a great day.